AS-12 Government Grant. Definition: it is the assistance by the government in cash or kind for past or future compliance with certain conditions. So government grant is an assistance by the government. It can either be in cash or be in kind for something past or for some future compliance with certain conditions. So there are certain conditions associated with past and future compliance, and the government will provide us assistance either in cash or kind. So that is known as government grant. So it is an assistance provided by the government. It can either be in cash or kind for past or future compliance with certain conditions associated by it. Then let's see the scope of AS-12. It excludes grants such as tax holiday period, tax exemptions, and government participation such as investment by the government in a company as equity shareholders. So tax holiday period and tax exemptions are a type of grant but not government grant as per AS-12. They are separate category. Now, government participation as equity shareholders. If the government is an equity shareholders of a company, that are also not treated as government grant as per AS-12. So, what is the recognition criteria for a government grant? A government grant is not recognized until there is a reasonable assurance that the enterprise will comply with the conditions attached to the grant and the grant will be received. So, in order to recognize a government grant, the enterprise has to comply with the condition associated with the grant. We have seen that there are certain conditions associated with government grants, right? So, the enterprise has to comply with those conditions and the grant has to be received. Only then it can be treated as government grant as per AS-12. Now, let's see the accounting treatment. There are two types of government grant. What are they? Non-monetary grant and monetary grant. From the name itself, it's clear. Monetary grant are grants that are received in cash, and non-monetary grant are grants that are received in kind, that is not in cash. Suppose if an asset is acquired at 1 crore rupees and the government refund 40 lakh rupees, it is a monetary grant. That means that we acquire an asset of 1 crore rupees and the government later provide us 40 lakh as a grant. So the government is giving us in cash, right? So it is a monetary grant. And in another case, we are acquiring the asset at 60 lakh rupees. We are acquiring the asset at 60 lakh rupees. The government has already deducted the 40 lakh from the total value of asset. The total value of the asset is 1 crore and the government has already deducted 40 lakh from it, and we are purchasing it for 60 lakh rupees. So we are not receiving anything in cash, right? So in that case, it is known as non-monetary grant. So two type of grant, non-monetary grant and monetary grant. So non-monetary grant can be of two. It can receive asset at a concessional rate or received asset free of cost. So received asset at concessional rate is what we already discussed. We are purchasing the asset at 60 lakh because government has already deducted the 40 lakh and is giving at a concessional rate. So when we receive the asset at a concessional rate, we have to record the asset at acquisition cost. At what amount we purchase the asset? We purchase the asset at 60 lakh, right? So we have to record the asset at concessional rate, acquisition cost on our books of account. And if we receive the asset free of cost, we are receiving the asset free of cost. We are not paying anything for the asset. Does that mean that we need not record it in our books of account? No, right? We have to record it. At what rate? We have to record it at the nominal value. When we receive an asset free of cost, we have to record the asset at nominal value. That's all about non-monetary grants. Now what are monetary grants? Monetary grants can be further classified into three. It can be related to fixed asset, related to revenue nature, or in the nature of promoter's contribution. We will see each thing individually. First one, monetary grants are related to fixed asset. We know that the fixed assets are of two types, depreciable assets and non-depreciable assets. Let's see the monetary categories for depreciable assets. For depreciable asset, we can treat that in two ways. We can either reduce the grant from the cost of the asset. We can reduce the grant from the cost of the asset, or we can treat the grant as a deferred income and recognize in proportion to depreciation or life of the asset. It means that First one, we have to reduce the grant from the cost of the asset. Let's see the journal entries, then it will be easy. When we purchase an asset, what will be the journal entry? Asset account debit to bank, right? Now we are receiving the monetary again, we are receiving the cash, right? So we are receiving the grant of 40 lakh. Now what we will do in this approach, we will reduce it from the cost of the asset. So to reduce from the asset, reduce the book value of the asset, we have to credit the asset and debit the bank. So when we purchase the asset, that journal entry is asset account debit to bank, and when we receive the grant and reduce it from the cost of the asset, the journal entry will be bank account debit to asset. Now we have to provide for depreciation, right? Since it is a depreciable asset, we have to provide for depreciation. So depreciation account debit to asset. In what value asset we will take? We will take the value of 60 lakh, right? The total value of the asset is 1 crore and we are receiving 40 lakh as government grant. So the remaining value of the asset will be what? 60 lakh. Since we reduce the 40 lakh from the cost of the asset, the remaining value of the asset is 60 lakh, right? So we have to provide the depreciation on this 60 lakh. So that is when we reduce it from the cost of the asset. Now what if we treat it as deferred income? When we purchase the asset, journal entry is asset account debit to bank. And now we receive the grant of 40 lakh. We receive the grant of 40 lakh. What will be? Bank account debit to deferred income. Here we reduce it from the asset, but here we are crediting it to deferred income account. So bank account debit to deferred income account or deferred government grant account. Both either can be used. Now we are providing for depreciation. We will provide depreciation on what amount? 60 lakh here. No, we will provide the depreciation on the asset value 1 crore. We are not reducing this 40 lakh from the total value of the asset. We are just crediting it to deferred income account. So we will provide depreciation on the value of the asset. Gross value, what is it? 1 crore upon 1 crore. So depreciation account debit to asset. Now on proportional value, we will credit the deferred income to the P&L. Deferred income account debit to P&L. That means that we are receiving a grant of 40 lakh and now the useful life of the asset be 4 years. Now what will be per year cost? Per year value will be 40 divided by 4, 10 lakh, right? So we will credit these 10 lakh to P&L every year for coming 4 years. That is deferred income account debit to P&L 10 lakh. So that's how we will treat when it is considered as a deferred income. Asset purchase, asset account debit to bank. When we receive the grant, bank account debit to deferred income account, and depreciation will be provided on the total value of the asset. Depreciation account debit to asset, and on proportional basis on the useful life of the asset, we will credit the deferred income to P&L. Deferred income account debit to P&L. Hope it's clear. Now for non-depreciable asset. For non-depreciable asset also there are two types. First, we can reduce it from the cost of the asset, and if the company do not want to reduce it from the cost of the asset, let's see. For non-depreciable asset, reduce it from the cost of the asset. It is same as we discussed earlier. When we purchase the asset, asset account debit to bank, and now when we receive the grant, we will reduce it from the cost of the asset, right? So to reduce the book value of the asset, we will credit the asset and debit the bank account debit to asset. Now we will provide depreciation on what value? We will provide the depreciation on the net value of the asset, right? So depreciation account debit to asset account. Same as discussed earlier. Now if the company do not want to reduce from the cost of the asset, company doesn't want to reduce from the cost of the asset, what will we do? We have to check whether the grant is unconditional or conditional. We have to see whether there is any condition attached to the grant that is pending and whether the grant is unconditional. So suppose the grant is unconditional. If the grant is unconditional, we treat it as promoter's contribution. We will treat it as promoter's contribution. So actually promoter's contribution, we will credit it to the capital reserve. If it is treated as, if it is grant is unconditional and treated as promoter's contribution, we will credit it to the capital reserve, and this can be used to pay dividend and all. This should be reserved. This amount cannot be used to pay dividend or We couldn't treat it as deferred income or anything. So when we purchase the asset, what will be the entry? Asset account debit to bank. Now we receive the grant. What will be the entry? Bank account debit to government grant or bank account debit to capital reserve when the grant is unconditional. So the unconditional means when this grant is not expected to refund, or when the government is helping for building up a company, startup, etc. In such cases, it is treated as unconditional. Now, when the grant becomes conditional, now when the grant is conditional, we will treat it as deferred income as discussed. Deferred income should write off over the number of years pending for fulfilling condition. This we already see for depreciable asset. When we purchase the asset, asset account debit to bank. And now when we receive the grant, we will treat it as deferred income. Bank account debit to deferred income, right? Now we will credit the deferred income to P&L over its useful life. So deferred income account debit to P&L account. And that's all about non-depreciable asset. So we have finished grants related to fixed asset. Now grants related to revenue nature. So when grant received in revenue nature, we will usually see it under a separate heading as other income in P&L, and we will credit it in the statement of P&L. So that has to be noted. We will show it under other income and we credit it to the P&L statement. Now what are grants related to revenue nature? Generally, these grants are received to reimburse the expenses of the company. The company already incurred an expense and this grant is received to reimburse those expenses. That is known as grants related to revenue in nature. These can further be classified as grants received to reimburse expenses of 1 year. These 1 year expenses, the grant is received to reimburse it. And grant received to reimburse expenses of multiple years. And grant received for past expenses incurred, for something past expense. So first one, grant received to reimburse expenses of 1 year. It can further be classified as separate expense income or expenditure net of. In separate income method, here is separate income method. We will treat it as, when we receive the grant, we will treat it as a separate income. So when expense is incurred, expense account debit to bank, right? So when we receive the grant, we will treat it as a separate income. Bank account debit to P&L or bank account debit to government grant account. We will treat it as an income when we receive the grant. And when we incur the expense account debit to bank. Here we will consider it as a separate income when we receive the grant. Now expenditure net off method. In expenditure net off method, we will net it off. Like when we incur the expense account debit to bank. And when we receive the grant, we will reverse this bank account debit to income expense account. So we are netting off when we receive the grant. In this method, we are separate income method, we are considering it as a separate income, bank account debit to government grant account. Here in netting off, we are netting off the expenses, expense account debit to bank, and when we receive the grant, bank account debit to expense account. So that is when the grant is received to reimburse the expenses of 1 year. Now, when grant is received to reimburse expenses of multiple years for 5 years, we are receiving a 40 lakh for 5 years to reimburse the expenses incurred for 5 years. So, we will treat it as a deferred government grant. When we receive the grant, we will treat it as a deferred government grant, bank account debit to deferred government grant. And now where expense is incurred, what will be the journal account? Expense account debit to bank, right? And we will credit this deferred government grant account to P&L account. So we are receiving 40 lakh for 5 years, right? So in each year 40 lakh divided by 5. 8 lakh rupees will be credited to the P&L every year. So when we incur the expense, we will treat expense account debit to bank. That is the journal entry. And now what if we receive the grant? When we receive the grant, we will consider it as deferred government grant. Bank account debit to deferred government grant account. And on each year, we will credit it to the P&L, deferred government grant account debit to P&L. So that is when we receive the grant as reimbursement for multiple years. Now, if we are receiving the grant for past expenses incurred, when we receive for past expenses incurred, we will treat it as a promoter's contribution. No further conditions to be fulfilled. If we have no further conditions to be fulfilled, we will treat it as what? We will treat it as promoter's contribution. When we treat it as promoter's contribution, what we will do? We will transfer it to the capital reserve, and it can't be used to pay dividend or anything, and it shouldn't be treated as deferred income and all. So when the grant is received for past expenses, we will credit it to capital reserve. Bank account debit to capital reserve. So this is all about grant received as revenue. Now, grant received in the nature of promoter's contribution. So we have already heard the word promoter's contribution here and there. Now let's see what is exactly it is. Grant received to set up the business, plant or machinery in a backward region in a notified area. Suppose we receive a grant to set up a business, plant and machinery in a backward region in a notified area. This very much related to the work of the government, right? So in such condition, the government gives a grant and we will treat it as a promoter's contribution. So when it is considered as a promoter's contribution, what we will do? We will credit it to the capital reserve, bank account debit to capital reserve account. So that's all about promoter's contribution. Now the final topic is a refund of government grant. So we have accounted for government grant differently, right? First, if grant received was adjusted to the cost of the asset. The first case we have seen that we reduced it from the cost of the asset. So what will we do if the grant received was adjusted to the cost of the asset? If the grant received was transferred to the deferred government grant or deferred income, if the grant received was treated to capital reserve. These are the three conditions that we see. Now, if we have to refund the grant, we may refund the grant because the conditions cease to be fulfilled. If the company doesn't fulfill the conditions, then we have to refund the grant. So in order to refund the grant, how will we account for it? Let's see. If the grant received was adjusted to the cost of the asset, we have reduced it from the book value of the asset. What we have to do? We have to increase the book value of the asset. We have to, when we receive the grant, we reduce it from the book value of the asset, right? So now when the refund is necessary, we will increase the book value of the asset. So asset account debit to bank, as simple as it is. But we have provided depreciation on the previous years, right? So in this case, when we reduce it, when we adjust the cost of the asset, there is no retrospective effect. We do not have to change anything that we done in the past. We just have to prospectively change the depreciation. Suppose after depreciation the value of the asset is 40 lakh currently, and now we have to refund a 5 lakh rupees to the 5 lakh grant to the government. Then we will consider the value of the asset as 45 lakh and we will provide depreciation for this 45 lakh. So there is no retrospective effect, only prospective changes has to be made. So when we reduce it from the cost of the asset, we have to just increase the book value of the asset account debit to bank, and only prospective change. Now, if the grant was transferred to deferred government grant or deferred income, we have also seen that we transfer it to deferred government grant, deferred income in certain cases. Now, how will we account for the refund in such cases? We have to. So, we have transferred to the P&L. We have transferred to the P&L. We have credited the deferred government grant account to the P&L in situations, right? So, we have to debit the balance after writing off to the P&L. Suppose we write off 40 lakhs to P&L. Suppose we write off 40 lakhs to P&L, but the government grant we received was 60 lakh. We receive a 60 lakh as government grant, and over the course of the years, we have credited 40 lakhs to the P&L as deferred income. Now, what is the remaining in deferred income? In deferred government grant, there is a remaining of 20 lakhs, right? So we have to debit the 20 lakhs rupees, and what is the remaining we have to repay to the government? 20 lakh we have provided it from deferred government grant, and the remaining is 40 lakhs, right? So on the total of grant 60 lakh, there is a remaining 20 lakh, and we have debited the deferred government grant 20 lakh, and the remaining we have to take it from the P&L account, that is 40 lakh, and then to bank. 60 lakh. Suppose if the grant received was transferred to deferred government grant or deferred income, what we have to do? We have to debit the deferred government grant income, P&L account income, deferred government grant, P&L account, and to bank. So in deferred government grant, we write the balance after writing off it to P&L, and the P&L account we will amount transfer last year then to bank. The last one, if the grant received was transferred to the capital reserve. So we have credited it to the capital reserve. To refund it, what we will do? We will just debit the capital reserve account debit to bank. So this is all about refund of government grant. And actually, refund of government grant is an extraordinary item. We have learned extraordinary item in AS-5, right? So we had to disclose it as per AS-5. Refund of government grant is an extraordinary item. So disclosure should be as per AS-5. Hope this chapter is clear.